Welcome back to International Finance. I am Andy Kim, your Dr. Finance, and we've been going through Chapter 6 of Eun, Resnick, and Chulun's International Financial Management, which is about international parity relations. What is this chapter about again? It's about the force behind the FX market. What drives your FX market, right? The dark force. Right? The key drivers were interest rate parities and then purchasing power parity, IRP, PPP, and the connector between these two was Fisher equation, right? And then law of one price, all these kind of things were, recalled, right? And then once you know that the driver of this FX market is interest rate, okay, and you understand the inflation, how does that affect the FX rate going into the future? The question becomes, can you make money by forecasting this FX rates going into the future? Okay, the answer is no. In efficient market hypothesis, the answer is no. Why? We're gonna get back to this one, right? FX, foreign currency, is nothing but one of your assets that you invest, right? Just like stocks or gold or Bitcoin or anything, right? And then oils and then all these kind of things. The thing is, always there is a, the asset pricing is covering all these kind of investments, right? The key issue in asset pricing is, can we predict the stock price movement or the asset price movement, and then we can make money out of it or not. And then the big school of thought over here is Chicago, Minnesota, Carnegie Mellon school of thoughts, right? These guys are the strong believers of efficient market hypothesis. All the information about your asset is already priced, reflected in your price. 선반영됐다 in Korean terminology. 선반영, right? Now, so let's see. Financial markets are efficient if prices reflect all available information, right, and relevant information. If this is true, exchange rates will only change when new information arrives. Thus, the spot exchange rate of today is nothing but the expected value of spot exchange rate tomorrow or 1 year from now, okay? And forward rate, okay, that you see today is expected value of the spot exchange rate given today's information, all the information that you have right now, okay? So what is this about? This is expected, conditional expectation, conditioned on current information. Holy cow. Non-mathematicians, you will be spooked by looking at this conditional sign, but don't worry about it. Right? I'm not going to ask you how to derive all these kind of things mathematically. No, don't worry. But all that I'm trying to say is that, it's a expected value given those information right now, okay? Predicting exchange rates using the efficient market approach is affordable and is hard to beat, okay? And then it involves, right? Basically the key idea in efficient market hypothesis or EMH is that can't do anything. You cannot forecast future movement of your price or FX rates or whatever, because all this information is reflected in price right now, instantaneously, so much so that you cannot make money. The chances are gone by the time you realize, oh, here's a new information, so I can make money out of it, calculate it, and then buy. But the price is already up, so that you cannot make money. You will buy it expensively, like that. Oh, bad information comes in, and then I will short sell it. But by the time you punch in that short sell button, the price is already down. It's already gone instantaneously. That's the idea. So much so that, okay, the price moves just like a random walk. We call it martingale, right? Mathematicians call it martingale. And then it's a random walk. There's no way of predicting it in a systematic way. No way of making money. Anyway, as opposed to this efficient market hypothesis argument, there comes a couple of guys against it. One guy is coming in, one group of people against EMH are the guys from fundamental approach camp, right? Fundamentals, just like Warren Buffett, if you use, the price did not reflect those information yet so that you can make money. If you study the fundamental hard enough, then you can make money based on this fundamental. That's the key idea of Warren Buffett or fundamental guys. They don't believe in market efficiency. They don't believe in Chicago, Minnesota, Carnegie Mellon. So that's something understandable, hard to accept for normal people like you and me, because the Warren Buffett kind of guys have been well known as the gurus in the market. Presumably, we have a stereotype that those guys are good at economics and they should be the strong believers in economics, but they're not. They're not. They're not. The economists, what they claim is even stronger. That's why, okay? In efficient market hypothesis, right? So fundamental approach, what is it? It involves econometrics to develop models that use a variety of explanatory variables. In stock market, there you had to do some DCF analysis of cash flows and discount rates and DCF, get the present value, and then identify undervalued stocks. Here in FX market, it's difficult to do, like, what's the cash flow that you can expect from holding a US dollar? And then what's the, discount rate that you have to use? But here, instead, you work with some fundamental elements that drives this FX rate, okay? Fundamental economic relation, okay? So we're going to talk about that economic factors a little later in our appendix, so wait for that. This involves 3 steps: econometric approach, regression approach, right? Step 1, estimate the structural model. I just run regression, right? Step 2, estimate future parameter values. Estimate betas using your regression. That's the story over here. Step 3, use the model to develop forecasts. Well, use your beta estimates and then throw in new numbers into the right-hand side equation to use it to forecast future FX rates. That's step 3, okay? The downside, okay? Downside is that the fundamental models do not work any better than the forward rate model or the random walk model. Of course, we will say that because the writers of the textbooks, right? Including myself, not including myself, but the writer of the textbooks in mainstream finance, they are all strong believers in Chicago, Minnesota, Carnegie Mellon school of thoughts. The efficient market hypothesis. We are economists by nature, by definition. We are strong believers of market efficiency. So that's why we have to conclude in this way. Fundamental analysis does not work. Okay? If you test it, right? It is true, a lot of academic research has proven that it does not work that way. The fundamental approach does not work. You cannot make money like Warren Buffett in their way. And then you cannot make money in FX market. The FX market is very, very efficient. Very, very efficient. Okay? Why? I told you before, so many people watch US dollars, and then so many institutional smart monies, right? Institutional investors put their money every millisecond. So all the information about macroeconomy gets priced instantaneously. So that's why FX market, of course, efficient, right? It has to be. Yeah. We will come back to this point in Appendix 6.a, right? Wait for that. Another approach against EMH, efficient market hypothesis, is technical analysis, technical approach. If you have taken my behavioral finance class, you must be familiar with this idea of technical analysis. What is that? 기술적 분석, right? Copy trading kind of idea. It has to do with our basic instinct about visual pattern recognition, right? What is that? Look back in the price chart and then try to identify some visual patterns, right? Why do I say it is deeply linked to our basic instinct? Because over millions of years during our evolutionary process, our ancestors who were better and faster in visual pattern recognition had better chance of survival and better chance of mating. Okay? For example, you go to the field with your 돌도끼, like axes, right? Stone axe as a hunter and gatherer, right? You had to be fast in pattern recognition so that, those green pattern over there are grass and then trees, and those white pattern over there jumping around, that's rabbit. You have the fast one by 1 millisecond faster in throwing the axe or bullet, the arrows like this, had better chance of eating it and bringing those prey to those families and better chance of mating and then, and things like that. And then if you are slower by 1 millisecond in recognizing the visual pattern of, that stripes of black and yellow over there in the dark, that's tiger. If you're 1 millisecond slow in recognizing and running away from it, you are dead meat, right? So that's why. And that kind of visual pattern recognition, right, dies hard. So that whenever we do anything like stock investment or FX investment, we want to, convince ourselves by looking at the chart and convince ourselves that there must be some pattern, so it's time to go up, let's buy it. Okay, that's the idea. Technical analysis looks for patterns in the past behavior of exchange rates. It is based upon the premise that history repeats itself. Thus, it is at odds with the EMH. So here is a fun picture. Like over here, this is Bitcoin chart. People were trying to do this kind of technical analysis by looking at the historical chart of Bitcoin to make money in that asset, right? What did they try to bring? Well, it seems like there is some more bumpy up and down, which looks like the cartoon character 기영이 in Korea. 기영이. Go ahead and find it, 기영이, right? This hair looks more like what? Bart Simpson? Okay, fine. So seems like 기영이 is raising up their left hand over there, so the price is going to go up. And then some people were like saying that, Coca-Cola, he is going to pop bottle up so that the price will jump up like crazy. Good luck. Actually, it was good luck for over the last couple of months, right? For Bitcoin, right? And then somebody even, brings some I am Groot, show me the money, right? Bitcoin price. They were trying to do it like this, right? That's technical analysis. But EMH guys, what do they say? That's bullshit. If this pattern recognition is correct and 기영이 is the right one that you have to use, and you were right in doing this so that you identify the buying opportunity, target price is over there, then what? You are not alone. And everybody is watching the same thing and then doing the same analysis as you do and come up with the same target price. And they will push the buy button together with you instantaneously right now. Right now. Yes. Size music. Right now. Go ahead and watch his music video. Right now. The price has to reflect all those things. But the price movement That has to be instantaneous. It's not happening right now. That means your technical analysis tool is bullshit. That's the idea. So moving average crossover rule, golden cross versus dead cross. That's one famous rule. The technical analysis guys use it. And then the idea is the golden cross is when your spot price or the current price moves above the historical moving average words, right? Oh, then it must be like it's time to go up, right? It confirms. And dead cross means what? Well, your current price goes down, 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 down. You're hesitant whether to sell or not. But if it crosses downward, passing through the moving average, right? How long moving average? 20 days or 3 months or 1 year? I don't know. God knows what. But if it crosses that, you justify yourself. This is time to sell. Dead cross. Right? That's the idea. And then another the popular method of doing it is head and shoulders, knees and toes, knees and toes, head, shoulders, and approaches, right? They just try to create this kind of visual justification, right? Of trying to identify this kind of neckline. Oh, this is a support. That is a resistance kind of things. So that you try to buy low and sell high somewhere. Okay? And then, all in all, the economist perspective, right? Is that this kind of thing is bullshit. And then, efficient market hypothesis holds true. And then, you cannot predict the price in a systematic manner. No way. Forecasting is difficult, especially with regard to the future. As a whole, forecasters cannot do a better job of forecasting future exchange rates than the forecast implied by the forward rate. So forward rate is the best predictor. That's it, okay, of your future spot exchange rate. The founder of Forbes magazine once said, you can make more money selling financial advice than following it. Yeah, okay, fine, that's that. And next set of lecture, I'm going to cover the appendix of chapter 6. So wait for that. Thanks for watching.